Hey everyone, welcome back to Corporate Decoder. Today Newell Brands Inc. NWL has filed a Form 8K announcing a new debt offering, and I am seeing a clear strategy at play here. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is raising a significant amount of money by selling new bonds and plans to use it to pay off older, more expensive debt, which could be a smart move to improve their financial health. Alright, let's dive into what Newell Brands Inc. NWL has put out in their latest filing. It is a pretty straightforward report, essentially announcing a big financial maneuver they are undertaking. The core of this report is about money, specifically the company is launching a private sale, meaning they are selling directly to certain investors without the hassle of a public offering of $600 million worth of new bonds. These are called senior unsecured notes, which essentially means they are promises to pay back borrowed money, and they are due in 2031. This offering is happening because they are exempt from certain registration rules under the Securities Act of 1933. Think of it as a more private way to borrow money from big financial players. Now, why are they doing this? The company plans to use the money raised from selling these new bonds to do a few important things. First and foremost, they want to pay off their existing 6.375% senior notes that are due in 2027. These older notes are costing them more in interest compared to what they plan to pay on the new ones. So, this is a way to refinance their debt and hopefully save money on interest payments in the long run. They will also use some of the funds to cover the costs associated with this whole process, like fees and expenses, and to pay down a part of their existing credit line. This indicates they are actively managing their debt structure. This move to pay off the older, higher interest debt is a key financial strategy. Companies do this to lower their overall interest expenses. If they can borrow new money at a lower rate than their existing debt, it is like refinancing your mortgage to get a better interest rate. This can free up cash flow that can then be used for other purposes, like investing in the business, paying dividends, or further reducing debt. It is a sign that they are being proactive about managing their balance sheet. Now, looking at the broader context, Newell Brands NWL is in the consumer defensive sector, which generally means they sell products people need regardless of the economic climate, like household and personal care items. They have a market capitalization of around $2.6 billion, with their stock currently trading around $6.02. Recent news shows that the stock has been performing well, with some analysts expecting it to rise, and it even had a strong trading day recently. This debt offering comes at a time when the company's stock has been showing some positive momentum. The fact that they are selling these new notes to qualified institutional buyers and certain non-used persons outside the United States highlights that this is a move directed at sophisticated investors, not the general public. This is typical for large debt offerings. The new notes are being offered at a 6.250% interest rate, which is lower than the 6.375% on the notes they are redeeming. This difference, even though it might seem small, can add up to significant savings over time. Especially on a $600 million borrowing, this strategy of refinancing debt is a classic financial move. It can improve a company's profitability by reducing interest expenses. For Newell Brands NWL, this could mean more money available to invest in their brands, develop new products, or even return more value to shareholders. However, it also means they are taking on more debt, which always carries some level of risk. The key will be whether they can manage this new debt effectively, and if the savings in interest payments outweigh any potential drawbacks. Now, looking at the bigger picture for Newell Brands NWL, you see a company that is trying to strengthen its financial foundation. They have large institutional holders like BlackRock Inc. and Zena Investment Management LLC. These big investors usually pay close attention to a company's financial health and its ability to manage its debt. This debt refinancing move likely aligns with the expectations of these major shareholders. What I am actually looking for is how this debt restructuring impacts their overall financial flexibility and their ability to fund growth initiatives. If they can successfully lower their interest costs and still generate strong sales, this could be a positive step forward for the company. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.